Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host for Upticks. Today is our 54th episode, Lowering Your Taxes. Okay, Matt, welcome back to the show.
Thank you. Happy to be here.
Yeah, we're excited to have you back on. So for everyone that's tuning in or listening or watching us for the first time, Matt is in our advanced planning area of our team. And so what he's doing is he's been digging deeper into financial planning topics and finding ways to help our clients above and beyond a typical financial plan. Mm-hmm. So Matt, you've kind of uncovered and researched a pretty interesting strategy that we wanted to share with everybody today. So why don't, and it's all about lowering taxes. So I'm sure if you clicked on this, lowering taxes title piqued your interest. And so that was the idea. And so Matt, why don't you take it away and we'll kind of go into one of the strategies that you've been researching here.
Sure thing. Well, we all like lowering taxes. Who doesn't, right? So what most people know is that when you turn 70 and a half, you have a required minimum distribution from your IRA account. Now the government essentially has allowed you to grow your account tax deferred, and they have been able to grow and you don't owe taxes on that yet. However, once you take distributions out and you're required to, people know that you have to pay ordinary income tax, on those distributions.
Right.
So what happens is people begin to take out these required minimum distributions and it begins to eat away at your account. However, you owe taxes. Now, what less people know about is what's called a qualified charitable donation. And let's say we have a client who gives regularly to an eligible charity, or maybe they are looking into potentially just giving to a charity. What can happen is they can give that qualified charitable donation to the charity, and what happens is it's excluded from their taxable income. So they actually will not owe taxes on that distribution, which is nice because it allows them to kind of control what their taxable income is going to be, if you could say that. And then also it helps satisfy that RMD, or your required minimum distribution that the IRS is asking of you. So it's really a win-win scenario for a client there.
Yeah, so let's maybe role play a little bit with that. So let's say that, and just to make sure that I'm understanding this correctly, so let's say that we have a client, and to simplify things, let's just say that they're single, and let's say that they have $1 million in their IRA.
Okay.
And I know, and so again, this is for everybody that's 70 and a half years or older is who this applies to. So if you're watching or listening to this and you're 50 years old, maybe this will apply to your parents, or if you're younger, maybe your grandparents could take advantage of this. So in this scenario, our person has $1 million, our client has $1 million, and typically that requirement is around 4%. It could be a little higher, a little lower, but let's just say their required minimum distribution for 2019 is $40,000. That would be 4% of $1 million. Okay, so, and let's say that they're living off of Social Security, they get a pension, and so they don't really need to take this distribution to live off of, but the government is making them do it. So what are you suggesting they do?
So what they could essentially do is find a charity that is eligible, that they feel like deserves the funds. And so what they can do is they can take that distribution and they can actually give it to the charity, and what happens is it's excluded from their taxable income, so they will not owe income taxes on that distribution.
Right. So do they have to give the whole $40,000 to the charity though? What if they don't want to give all of it away?
They don't. So let's say that they wanted to give away half to charity. So if they wanted to give away the $20,000 to charity, and then let's say they wanted to keep $20,000 for themselves, they could essentially take $20,000, give it to the charity, not owe income taxes on it, and then they could take $20,000 for themselves. However, that $20,000 will be taxable, so they will owe the income taxes on that portion of the distribution.
Right. That makes a lot of sense. So we've been rolling this out to our clients, and we've actually seen a lot of light bulbs go off, and it's been very exciting. Because what's typically happens is a lot of our clients are already donating to charities. So let's say they donate, I don't know, $500 a month to their church or somewhere, or to their favorite organization. And they didn't know that they could use a portion of their required minimum distribution to do so. And so we've opened up a lot of ideas with our clients on ways they can lower their taxes. Now, traditionally, and I think the reason that this is becoming more popular is that traditionally, couldn't people just write off their charitable donation? So what does it matter, Matt, if I got to take my required minimum distribution, it hits my checking account, I'm going to donate to my church, I'm just going to write that off of my taxes. So why is this strategy anything different than what people have been doing in years past?
Great question. So a big thing that's happening around us is the tax environment is changing, as we all know, and the standard deduction has gone up. So what has happened is in the past, people typically would itemize those deductions for their charitable contributions. And now it doesn't always make as much sense to itemize because of that larger standard deduction.
And what is that deduction approximately?
It's approximately $12,200 for individuals and $24,400 for married couples.
Right. So in our scenario here, if our client that had the $1 million didn't have any other deductions above the $12,200, then they wouldn't be able to get the benefit of donating to charity tax-wise. Is that what you're suggesting?
So typically what happens is you can still take your standard deduction. However, when you take a qualified charitable donation, you can increase your tax situation and your tax savings, if you will, and utilize that to exclude it from your taxable income.
Right. So you're not able to deduct it because you're not over the standard deduction, but by doing this qualified charitable donation, you're in effect keeping your taxes or actually lowering your estimated taxes.
Correct. You're able to control your modified gross adjusted income.
Yeah, so it's pretty awesome stuff. We like it, right? Our clients like paying lower taxes. I mean, don't get me wrong, everybody understands that, we need to pay taxes, but why would we want to pay more taxes than are necessary?
Yeah, and a lot of things, or a lot of times, what happens is people might be giving to charity regularly already from their IRAs, and a lot of times is they're already paying taxes and then donating to charity. If they go ahead and take this qualified charitable donation, they can essentially boost their taxes, savings, and then they can implement savings for themselves as well.
Now, is there a minimum? What if somebody only wanted to do $100? Could they do that?
To my knowledge, I don't believe that there is a minimum.
Right.
However, there is a maximum.
Okay.
Yes.
What is the maximum?
I believe it is $100,000.
Okay.
Yeah.
Right. So in any 1 year also, right? So if you wanted to do $25,000 a year, that's okay. It just can't be more than $100,000 in 1 year. Gotcha. But there's not a minimum either, right? So if somebody say, Jake, I've always given, $200 to my church and that's what I've always done, you certainly could do this as well. So it doesn't need to be $20,000 or whatnot. We might be splitting hairs a little bit, but hey, if we could keep that $200 or $2,000 or whatever it is off of your income, again, we're lowering your tax bill, which ultimately is going to translate into a better financial plan. And ultimately, that's what we're here to do for our clients. We're here to maximize your financial plan and, of course, help you on the investment side as well. But this is a big part of what we do, and it's been a lot of fun. And I think, Matt, you've also recently written an article about this as well, correct?
Yes, I have. I actually just wrote it, and it'll be coming out next week in the email. So keep an eye out for that.
Yeah, so this video will probably actually be in conjunction with your blog on this. So you can find our blog at falconwealthadvisors.com under the content section. And this video rolls out in our subscriber email where Matt's blog will go into a little bit more detail about this strategy. And certainly, if you have any questions, you can always reach out to anybody on our team at Falcon Wealth Advisors, or you can find Matt directly at matt@falconwealthadvisors.com.
Exactly, yeah.
Now, before we wrap up our show, because I have a feeling that a lot of our audience is probably under the age of 70 and a half, but again, the reason I brought this up is that this could be your parents that need help with this or your grandparents. And certainly if you want to connect them with us, we're happy to explain this strategy in a language that they can understand because it can get a little complicated. But for everybody under 70 and a half, we've also talked about this on a previous episode, but I wanted to touch a little bit more on bunching and what that looks like. So, we're in the theme of today's show, we're lowering your taxes through charitable giving. Let's talk about a strategy for somebody that maybe doesn't have a required minimum distribution because maybe they're 50 years old or 60 years old. What do they do? What can they do to lower their tax bill, Matt?
Great question. So another strategy is bunching, and just like we talked about earlier, the standard deduction has gone up. And so what happens is people are itemizing their deductions quite a bit less. So one strategy that they implement is when they're giving to charity, they use bunching. And what that is essentially front loading multiple years of contributions to a charity in order to take a higher itemized deduction than their standard deduction. So
Very good.
let me give you an example here.
Okay.
If we have an individual again, and let's say they're giving to charity, we'll give an example of $5,000.
Okay.
Let's say they give $5,000 every year to a charity that is eligible. What they'll do is,
Well, let me pause you here. What does eligible mean?
so there's certain charities, they have to have a certain qualification by the IRS in order to take these deductions.
So your brother or sister wouldn't be eligible.
Correct. As much
Or
as
your-
they might like that.
Right. So it's typically a 501c3.
Exactly.
Right? So they have to have a registration that they are a charitable organization.
Exactly.
Okay, so that's what Matt means when he's talking about that. Okay, so they give $5,000 a year to this 501c3, but they can't really itemize because, let's say in this example, that is their only deduction. So they're not over that $12,200 threshold. So they're really not able to write it off on their taxes.
Exactly.
Right,
So,
so
it's
go
not
ahead
very
with-
beneficial to them.
Right, right. So go ahead, let's go through the scenario here.
Sure. So let's say they front load 3 years worth of contributions. So that's $15,000. Essentially what you can do is you can itemize the $15,000 of their contributions there because that is larger than your standard deduction.
So you could deduct that spread. So whatever's above the 12,200, now you're deducting that from your
Well, you'd be able to deduct that full 15,000.
right, as opposed to just 12, right?
Correct.
I get it, yeah. So
Yes.
you get more than the 12.
Yes. So essentially what you're doing is you get that higher amount of deduction that first year, and then you can take the standard deduction the next 2 in which you would be giving those contributions. So essentially over the course of those 3 years, you're getting the highest deduction amount possible there is what the thinking is.
Right, and the idea is you don't have to give all that money to the charity up front. So you can still give to the charity every 3 years. And actually, through our services, you can actually keep the money invested if you prefer also. So we can invest it in the market, and now it's actually growing tax-free because as long as you give it to a charity, you don't have to pay taxes on any of that growth. So it's a really good strategy. Also, if you have highly appreciated stock in your account, you can donate it into what we're talking about as a donor-advised fund and not pay capital gains on that stock either and still get all of the great benefits that Matt just talked about.
Yep.
So bunching is good if you're not 70 and a half, you are charitably inclined, and you're not able to get above that standard deduction. So a quick item here, takeaway, is that if your accountant or your CPA, if they're telling you you don't have enough to deduct, that's when the light bulb should go off for you, and you should contact Falcon Wealth Advisors and say, hey, my accountant says I don't have enough deductions, but I do give to charity. Can you mock up a scenario? And we certainly are happy to do that, and that's part of what you're doing on our team for our clients, Matt.
Exactly. Yeah.
So it's fun. It's fun. We like it. I know we're dorky finance guys, but we thought that there would be a lot of value in this. So for people that are giving to charities, there are ways to continually lower your taxes. Certainly if you're retired and over 70 and a half, that's a no-brainer. But if you're younger than that and you are giving it to charity and you're not able to itemize those charitable donations, let's take a look at bunching. And again, certainly give us a call, and we're happy to set up a time to meet and go over this strategy in more detail.
Yep.
Now, Matt, moving into our fun part of today's show, I've already done the lightning round with you. I've already asked you how you learn about money. I guess I wanted to talk about your summer. I know you moved back from Colorado. You just decided to rent a place downtown
Yep.
With a friend. And just want to see, is there any good new restaurants that you found that you'd recommend? Or are you reading anything or watching anything? Do you have any tips for our listeners out there of how you're re-embracing Kansas City life?
Well, I have been spending plenty of time just walking around downtown. There's plenty to see down there and plenty to explore.
Do you have a favorite pub or a restaurant yet?
That's a good question. Honestly, I don't yet. I'm trying to find a new hangout spot. I do like to go to the Phoenix every once in a while and just enjoy some music and have a couple of cocktails potentially.
Yeah,
and just
that's a
enjoy
good
some
one.
time with friends.
So the Phoenix is downtown in the Garment District, and I think is it a jazz
It is.
jazz
yeah.
clubs? They play live music. Do they play live music every night?
They do, I believe, yeah.
No.
Which is fun to go out and just listen to some music and take in the environment. So that's been fun. And
What about the Savoy? Have you been to the Savoy? I know they reopened that. Isn't that close to the Phoenix?
You know, I'm not sure.
Okay.
Honestly, I'm like I said.
Maybe I know downtown better
I'm
than you, Matt.
exploring still.
Well, good. Well, we're glad to have you back in Kansas City. What about? Are you into TV shows or Netflix or anything? You watching anything good?
Well, honestly, after Game of Thrones ended, my heart has been broken. I'm having a tough time getting back into any TV shows.
I feel like the tide went out. I feel like everybody was so enthralled in that, and we were talking about it every week.
Yep.
And now there's nothing on anybody's radar.
Yeah, it's just it's an empty wasteland out there.
I'm still reading a really good book called Billion Dollar Whale. I'm getting ready to finish it. It's about Joe Low, this Malaysian businessman who was very corrupt. It's crazy. If you would have told me this book was a novel, I would have believed it. And it's actually a true story, which is crazy. It makes it even more crazy. But this guy's, basically filtered all kinds of government money in and out and all of these different entities and then used it for his own personal gain. And he threw some crazy parties and bought some unbelievable things. And some of it's kind of disgusting, the way that he used this money, again, for his own personal benefit. And all for one big facade, because it was all, in my opinion, a lot of ego driven, that he just wanted to be seen as this successful billionaire or millionaire or from family money. So if you're a reader, I'd encourage you to pick it up. It was popular probably a few months ago. It's taken me a while to read it, but I really have enjoyed it. It is a good one out there. It's called Billion Dollar Whale. If you're into finance like I am, it's a pretty fun read, and I found it pretty entertaining. So
Interesting.
Yeah. So again, thank you as always. Again, we've subbed out Corey. Corey will continue to be on our shows, but actually Corey's launched his own show, which he's had a lot of success with. He just had his first episode. It's called Central Missouri Alumni Stories, and where he is interviewing alumni of Central Missouri, his alma mater, which is pretty fun, and he's pretty excited about that. So stay tuned for that. We'll certainly be sharing more of Corey's content as he produces it out there. But as always, please subscribe to our YouTube channel. That list is starting to grow. If you're listening to us on podcast through iTunes or Spotify, thank you. Please, feel free to hit the 5-star button if you want to give us a rating. You also can find all of our stuff on social media. We're on Facebook, Twitter, LinkedIn, and Instagram. If you're on Twitter, you can certainly follow me at Jake Falcon CRPC. And I think, Matt, your preferred way of being contacted is through email.
Yeah, it's matt@falconwealthadvisors.com. If you have any questions about anything that we discussed today, I'm happy to talk to you about it.
Yep. Thanks again for tuning in, and we hope you all have a great week. All right, Matt.
Sweet.
That was pretty good.